Hello investors and traders, welcome back to my channel. This is Junoy with Trading the Charts Pro, and in this video guys we're going to talk about how to protect your account in a market sell-off. All right, I'm going to be breaking down one strategy that I use to lower my risk and also make some profits as the market sells off. Okay, if you're a long-term investor, this is going to be a very interesting video for you. You can actually learn a few stuff that you can apply to limit the bleeding in your portfolio as the market sell off. All right, so if you're new to the channel, please like this video, subscribe, and turn on your notification bell so that when my next video comes out, you'll definitely be the first to get notified. All right, let's jump on and start talking strategy. All right, on the screen here guys, I have a breakdown of put options. All right, we're gonna talk how do we use put option as a strategy to lower our risk as the market sells off, because you and I know that the market does not go up every day, or it doesn't go up all the time. There are significant changes in the way the market move over time. All right, the market move up, it go down, and it also goes sideways. So in order to be able to manage your account in all of these different situations, you need to have a different set of tools in your tool bucket. You cannot use a saw to fix every problem while building a house. You definitely need a hammer, you need nails, you need screwdriver, you need drills, you need all of that different type of tools. So when it comes to the stock market, guys, we have to understand that it's pretty much the same thing. The stock market, is like building a house. So you definitely have to have more than one strategy in your toolkit so that you can navigate all the different, turns, ups and downs that the market throws at you. Okay. And this is one strategy that I like to deploy typically when the market is selling off. Okay. All right. So put option. A put option is simply a contract that gives the holder the right to sell a stock at a specific price for a specific period of time. Right. So typically with put option, when the market is selling off, let me bring a chart in so that I can show you a quick example. What am I talking about? All right, so with a put option, we see, Apple, this is the ticker here, price run all the way up to 137, and then day one we start to pull back, as well as the overall market starts falling. Now guys, as far as it comes to options, in order to be able to trade options, one option contract controls, so one contract in option controls 100 shares of stock. Okay, so I'm gonna break this down two ways. Typically, as far as Apple goes, in order for you to play put options against the stock that you currently hold in your portfolio, you would have need to have 100 shares of Apple to be able to sell one put option or buy one put option contract to cover your entire position. Okay, so guys, basically when Apple started to sell off right here at the 137.69 price, you could have come out and just buy one contract put option for a specific price for a specific expiration. You can go 3 months out, you can go 90 days out, or you can go 2, 3, 4, 5 weeks out. It really depends on how long you think the sell-off is going to continue. All right, so basically if you had 100 shares of Apple in your portfolio, which basically 100 shares of Apple, 137 times 100, guys, you're looking at $13,700. So you have a stake in Apple for $13,700, right? Price is at $137. Now the market started to sell off. You want to protect your $13,700 without just selling the stock because you like the stock, they pay dividends, all of this good stuff. There's still going to be, a move higher in the future, but you are a investor in Apple. You're not trading Apple. So you want to hold this position and not just sell it because the market is pulling back. Now, how do you protect this position without liquidating the position? Well, this is where the option skills come in, because you could have actually come out here, let's say January, and buy a January $140 put option. Okay, so that's $140 put. You're buying one contract, one contract, because I'm not writing that pretty, because you just want to protect your 100 shares. So you probably paid, maybe you could have paid around $14 for that put option. Okay, so $14 for the put option, because the put option control 100 shares. This is going to be 14 times 100. So your overall price for that put option is going to be $1,400, guys. So as a insurance strategy, you just basically protected your $13,700 estimated, which you have in Apple stock, for only $1,400, right? And now the put option that you bought, price fell, man, this thing is down roughly $30. So your put option that was, at the money when you bought it, now it's so deep in the money. So something you literally bought for $1,400, guys, this put option probably going for $5,000 to $7,000 right now, because this price had dropped down around 30 points. So you see what I'm saying? So yes, your long-term position would have been down around 3,000 something, because we lost around 30 points. 30 points times 100, that's around 3,000. But what you've ultimately done is you've used the put option to make $5,000 while maintaining your long-term investment. So though your long-term position is down, you are still net positive 2,000, which is the difference from what your long-term position is down and what you made, on the top side from the put option, which we say around 5,000 to 7. We're going to go with the lower number, and we're just going to work with the 5,000. You would have been net positive $2,000 just by using a little put option to protect your long-term position. So now price fell. If the support holds, let me clean this up just a little bit. If the support holds right here and price start to come back around, now guys, you just buy back that put option, put that 2,000 profit in the bank, right? Put the 2,000 profit in the bank and allow your long-term holding position to recover. So when this position recover, comes back to, if you had bought at the 137, now you actually got back your 3,000 that you were down. Guys, this is sweet. So now, just by price getting back to the 140, because you deployed the put option strategy, you're actually now net positive around 5,000 using just the estimated numbers, guys. So this is one quick strategy you can deploy to basically protect your account as an investor while the market sells off, without actually liquidating your position and waiting to buy back, or just be sitting in a loss waiting for the market to recover. All right, guys, I want to go a little bit further. That was the example. Now I just want to get into a little bit more details into the option, what is the put option and all that stuff. So basically, put options, they are trading on any stocks. They're also trading on commodity. They're also trading on currency. Okay, I don't necessarily trade them with currency, but yes, I trade them on stocks, index, stuff like that. Put options also, increase in value while the underlying asset depreciates in value. Okay, so while the stock price is going down, your option is actually going to be making money. All right, so that's something very, very nice to know. Let's jump to this other slide. Okay, put option strategy in the market sell-off, guys. So basically, you buy at the money put option if you basically own the stock. This is a hedge against the market sell-off, because while your long-term position is actually losing value, the put option that you bought is actually going up in value. So this strategy is really hedging against the market sell-off. Okay, now what if you are in the market and you currently own a put option already? Now you can actually go and buy or sell, you know, a put option at the money to lock in, or what we call create a spread and allow time premium to depreciate. Okay, that's also another strategy, which if you're strictly a option trader and you currently have 1 contract or 5 contract in the market trading options, you can go in and then create a second leg on that position, which selling option or buying option against option, that now becomes a spread. Okay, if you currently own the stock and you're buying or selling puts against your position, that is pretty much just hedging the overall movement of the market, in this case if the market is selling off. All right, so guys, if you like this video, if you found some value in this quick video, please hit the like button, subscribe to the channel if you haven't, so that when my next video comes out, you will definitely be the first to get notified because you have turned on your notification bell. Until then, guys, I look forward to seeing you in my next video.